Okay, let's just jump right in. Think about this number for a second. Nearly $1.8 trillion.
Mm-hmm.
That's the amount of commercial real estate loans set to mature in the U.S. before 2026 even hits.
Yeah.
I mean, that's like a tidal wave of refinancing heading straight for a market that's already, well, let's say, navigating some pretty choppy waters. Higher interest rates, big shifts in how we actually live and work.
That 1.8 trillion, it's absolutely central. You really can't understand the pressure points in CRE right now without keeping that figure in mind.
Right.
It highlights the scale of the challenge, doesn't it?
Yeah.
Borrowers are facing totally different financing conditions compared to when they, took out that debt initially.
Totally different world.
Exactly. It's a market where you've got like resilience and vulnerability sitting right next to each other.
Mm-hmm.
Depends heavily on the sector, sometimes even the specific building.
Yeah, exactly. And that dynamic picture, that's really what we want to dive into today. U.S. commercial real estate. We're trying to get past just the headlines about, distressed buildings falling apart. We want to look at the core stuff, the places businesses actually operate, where we all go shopping, where all the goods get stored and moved around. So specifically, office, retail, and industrial properties. Those are the big three we're focusing on.
And we've pulled together insights from quite a few recent reports, market outlooks, stuff from the experts in the field.
Right.
The aim here isn't like an academic lecture or anything. Yeah. It's more about guiding you, the listener, through what these sources are saying. We want to pull out the most important data points, the key trends, the challenges, obviously, but also maybe where the opportunities are starting to pop up.
Yeah, cutting through the noise.
Exactly. Finding those nuggets of knowledge about what's really going on in these vital sectors right now and what the forecasts are looking like for 2025, maybe even a bit beyond.
So our mission, basically, is to distill all this information, only drawing from the source material we have in front of us, so you can get a clear, informed view of this, frankly, a pretty complex landscape, without getting totally bogged down in jargon. We're trying to make sense of it together.
Because understanding these physical spaces,
right,
and the forces acting on them, it gives you essential context for the wider economy, context for the investment world. It all connects.
Okay, so speaking of the wider economy, to really get CRE, you've got to understand the foundation it's built on first. So what's the backdrop? What does our source material tell us about the general U.S. economy right now?
Well, the reports, they generally paint a picture of surprising resilience, actually, continued strength. If you look back at, say, the third quarter of 2024, the economy grew at a pretty strong 2.7% year-over-year clip.
Okay, 2.7%.
Yeah. Now, it's expected to slow down a bit from that pace, sure. But the consensus forecast, at least from these sources, is for growth to settle into a more, let's call it normal or sustainable pace, somewhere around 2.2%.
So not exactly booming, but definitely not like a recessionary vibe either.
Precisely. It's providing that necessary sort of underpinning for real estate activity, a stable base, more or less.
And if you break down that growth, where's the energy coming from mainly?
Well, consumer spending is always the big engine, right? Largest part of the U.S. economy.
Yeah.
And it's still showing strength, growing at a solid 3.0% pace, according to the data we looked at.
Still spending.
Yep. And business investment is chipping in too, growing around 3.6%. That's actually right in line with this historical average pace, so steady.
Okay.
What's kind of interesting or notable maybe in the recent data is the role of government spending. That's been growing well above its average. It actually accelerated to a 4.1% pace over the last couple of years. That's added a pretty significant boost to the overall GDP numbers.
Okay, here's where it gets really interesting for me, though. Looking at the sources, the condition of the U.S. household. They really highlight this as like a key strength, a sort of hidden resilience factor for the whole economy and, by extension, for consumer-driven stuff like retail real estate.
Yeah, that's a great point.
I mean, unemployment ticked up a bit, sure, 4.1% mentioned in one report, but we still added, 2.2 million jobs over the last 12 months. Employment's up 1.4%. That's pretty solid job growth.
And crucially, with inflation finally starting to ease up a bit,
finally,
we're seeing positive real wage growth again, which is key. It's running at about 1.3%, the data says.
Right.
And real disposable income, so income after inflation, that's also growing, about 2.7%. keeping pace with its long-term average.
So bottom line, people have, on average, a little more actual spending power in their pockets.
Exactly, which fuels that consumer spending number we just talked about.
But the detail that really jumped out at me from the reports about households was their balance sheets. They're apparently in their best shape in almost 40 years.
It's quite remarkable, isn't it?
Yeah. The total household debt-to-assets ratio is incredibly low, like 11%. And the debt service burden, how much income goes to paying debt, just 9.8%. These numbers are, like, historically strong. It suggests the average household isn't drowning in debt, which gives them a buffer, right, against economic shocks.
Yeah.
And it supports continued spending. It feels fundamentally different from, say, right before the GFC.
Absolutely. It's a very different setup. Now, shifting gears a bit, from the real economy to the financial side, the inflation picture, that's improved quite a bit. Deceleration is the key word.
Right.
We saw the CPI, the Consumer Price Index, at 2.8% year over year back in February 2025. But the forecasts embedded in our sources, they see it settling down closer to the Fed's target, maybe around 2.1% as we look towards the end of 2025.
And that trend, that disinflation, that's obviously huge for the interest rate outlook, right, on capital markets. Things have been pretty volatile there.
Extremely volatile.
I mean, the 10-year Treasury yield, which is, a key benchmark for borrowing costs, mortgages included, it climbed pretty dramatically late last year, 2024, hit 4.7% after being down at, 3.6% just a few months before.
Yeah, big swing.
But the consensus you're saying from the sources is that 4.7% was likely the peak. And the forecast is for that 10-year yield to maybe drift lower towards the end of 25.
That's the general view presented, yes. The forecast for the 10-year Treasury, it's usually seen as a mix of, expected inflation, the expected real interest rate, which is heavily influenced by Fed policy, and then this thing called a term premium, the extra yield investors want for holding longer-term debt.
Okay.
So based on the forecast we're seeing for inflation around that 2.1% mark, and an implied real rate the Fed might aim for, maybe 1.4% plus some term premium.
Yeah.
Well, that suggests an implied Fed funds rate target somewhere in the range of 3.5% to 4.0%.
And the Fed itself, they held rates steady at 4.5% in early 2025, right? After making some cuts late in 2024. So the market, based on these reports, is kind of betting on more gradual cuts coming through 2025.
That seems to be the expectation baked in, yes. Further easing. And look, if lower borrowing costs actually happen, that could obviously provide some much-needed oxygen for CRE financing.
Yeah, no kidding. And what about other places capital might go? How does CRE stack up against, say, bonds or stocks right now, based on the outlook in these reports?
Good question. The sources give a little context there. Bonds, for instance, are expected to offer returns somewhere in the 4% to 8% range in 2025. That makes them way more competitive than they were, in the post-GFC decade of super low yield.
Right, you can actually get some return on bonds again.
Exactly. Then for equities, for stocks, the forecast for corporate profit growth seems aligned with GDP growth, maybe 5.5% to 6%. But this is the key, but the sources point out the valuations look kind of stretched.
Yeah, PE ratio is high.
Right. Trading at 24.3 times trailing earnings versus a 5-year average around 21.4. So the thinking is, even with decent earnings growth, those stretched valuations might mean total equity returns could be lower than you'd think based on earnings alone. Maybe 6.75 to 7.25% range, according to one specific forecast mentioned.
Okay, so bonds are competitive. Stocks may be less exciting than earnings suggest, and that brings us right back to a big challenge for private real estate, this valuation lag. Can you unpack that? The sources mention a pretty big gap.
Yeah, this is crucial. There's a significant difference, a lag, between the cap rates used to value properties and benchmarks like the NCREI Property Index. It's widely used for tracking institutional core real estate performance, and the cap rates we're actually seeing in real market deals.
So the index isn't reflecting reality quick enough.
Essentially, yes. The NCREI index cap rate was reported at 4.8% at the end of Q3 2024. But if you look at data from, say, Green Street, which tracks actual transactions, nominal cap rates were ranging anywhere from 5% up to 7.6% across different sectors.
Wow, that's a big range.
It is. And even within NCREI's own data, if you look at the assets that were actually sold in 2024, the average cap rate was 5.9%. That's over a full percentage point higher than the index valuation.
Okay.
So this gap, this lag, it tells you that the reported values in some portfolios, especially maybe older appraisals, haven't fully caught up to where the market is actually clearing transactions. It creates uncertainty about what things are truly worth and likely means more adjustments are still needed.
Okay, so that definitely sets the economic scene and gives us the capital markets context. Now, let's zone in on CRE itself as an investment asset class within all this.
Right. So historically, commercial real estate, it's been a cornerstone for big institutional investors, right?
Yeah.
Pension funds, endowments, sovereign wealth funds.
Yeah, they love the diversification, the income.
Exactly. Diversification, stable income, potential for appreciation over time. And especially after the global financial crisis, when bond yields just absolutely cratered, CRE looked really attractive. Institutions piled in, shifting money out of those low-yielding bonds and into real estate to chase yield and boost their portfolio returns.
But then, the music stopped, or at least changed tempo, when interest rates shot up starting in 2022.
Precisely. Suddenly, fixed income wasn't boring anymore. Bonds started offering yields we hadn't seen in, well, years. So naturally, some of those institutional investors started rethinking things. In 2023, many began to pull back, or at least hit pause on putting new money into real estate.
Makes sense. Why take the illiquidity risk of CRE if you can get a decent yield from a bond?
That was the thinking for some, yes. But what's interesting, according to the sources, is that the fundamental long-term argument for real estate hasn't really gone away. Despite these shorter-term shifts in allocation, CRE is still seen as pretty well-positioned for the long haul.
Why is that?
Well, two main things. One, its potential as an inflation hedge. The ability to raise rents over time can help income keep pace with rising prices. And two, its historical track record. Over mid to long periods, real estate has often outperformed bonds. For investors with long-term goals and liabilities, those qualities are still really appealing.
We also heard about this denominator effect causing problems, right? Can you explain that quickly?
Yeah, that was a real headache for portfolio managers. It works like this. In 2022 and early 2023, public markets, like stocks, fell pretty sharply and quickly. But private real estate values, especially in these big core funds, they adjust much more slowly, that valuation lag we talked about.
Okay.
So even if an investor didn't put any new money into real estate because their stock portfolio shrank while their real estate portfolio value stayed relatively high, the percentage of their total portfolio allocated to real estate suddenly ballooned. It went above their target allocation purely because the other part, the denominator, shrank faster.
Ah, got it. So they were overweight real estate without even trying to be.
Exactly. And the sources cite a survey showing something like 40% of investors were over their target allocation in 2023 because of this, a big jump.
But are those pressures easing now?
The report suggests they are starting to, yes, for a couple of reasons. First, public equity markets bounced back quite strongly in 2024, which helps rebalance things. Second, those necessary price adjustments and write-downs have started happening in private real estate, bringing valuations down closer to market reality.
So the denominator grew and the numerator shrank a bit.
You got it. And interestingly, a survey mentioned from the first half of 2024 found that 45% of investors were actually underallocated to real estate. That's a huge swing from the year before. It suggests that maybe the pause, driven by the denominator effect in the yield comparison, might be nearing its end.
And are we seeing big investors actually, putting their money where their mouth is on that long-term commitment?
We are seeing some signals. The sources mentioned, for example, Singapore's GIC Massive Sovereign Wealth Fund actually increasing its long-term target allocation to real estate. And South Korea's National Pension Service, another huge player, is upping its target for alternatives, which heavily includes real estate. Those are, pretty powerful signals that the big money still believes in the long-term story.
What about all those headlines about people trying to pull money out of real estate funds, those redemption queues?
Yeah, that's an important point to clarify. The sources indicate that while, yes, there are liquidity challenges in some specific fund types, it's often not a sign of investors trying to exit CRE entirely.
Okay.
It's frequently more about rebalancing within their real estate holdings, maybe shifting from core to value-add strategies or moving between different managers rather than a wholesale flight from the asset class. The core benefits lower volatility than stocks, low correlation, adding diversification, stable income. Those are still highly valued for building long-term portfolios. It's about risk protection as much as return.
And the market itself is getting more sophisticated, right? More ways to invest than just buying a building.
Definitely. The sources talk about the maturation of capital in the CRE space. You're seeing a wider range of strategies now, things like recapitalizations, bringing new equity into existing deals, secondary market trading, buying and selling stakes in existing funds, joint ventures between capital partners and expert operators, more direct partnerships. It allows investors to be much more targeted about the risks and opportunities they want.
Okay, that's a great overview of the investment side. Now, let's really get into the weeds. Let's zoom in on the actual sectors, starting with the one everyone's talking about, usually with a bit of a grimace: office.
Oh, yes, office.
Yeah.
The current problem child for many. So office properties, obviously, these are the places designed for professional work, the heart of many downtowns and suburban centers. And the picture right now, early 2025, based on these reports, is challenging, though maybe with a few tentative signs of stabilization here and there.
Challenging seems like an understatement sometimes. What's the headline stat?
Vacancy. Yeah, vacancy is the big one. The national vacancy rate is sitting high, 14.1%, according to one source we looked at. And that high vacancy, it's driven by two things happening at once.
Okay.
One, continued negative absorption. That just means tenants are giving back more space than they're leasing. And two, new buildings are still being completed. Projects that were started a few years ago when things looked rosier. About 24.5 million square feet delivered recently, adding to the supply.
So more space coming online while demand is weak. Not ideal.
Not ideal at all. And one report even forecasts that the overall U.S. office vacancy rate, using a slightly different measure perhaps, could peak even higher, potentially hitting 19.7% by the end of 2024. That's nearly 1/5 of all office space sitting empty.
Oof, 19.7. Okay, so demand is soft. But you mentioned tentative signs of stabilization. Are things getting less bad on the absorption front, maybe?
There's a nuance there, yeah. Well, net absorption is still negative nationally, about minus 20.5 million square feet over the last 12 months. The pace of that negative absorption seems to be slowing down in some places.
How so?
Well, the reports note that the number of tenants actually moving out dropped significantly, like threefold year over year, ending Feb 2025. And the thinking is, this is linked to companies finally getting serious about their return to office policies. They're making decisions, enforcing them, and so maybe there's less drastic downsizing or outright lease cancellations happening now compared to a year or two ago.
Okay, so maybe the bleeding is slowing, but it hasn't stopped. What about rents? With all that empty space, landlords can't really push rents, can they?
Not much, no. National office rent growth is basically flat, just a tiny 0.2% gain quarter over quarter, which works out to only 1.1% on an annual basis. Very modest.
And I bet that's just headline rent. The effective rent after concessions is probably worse.
That's highly likely, yes. While the sources didn't dive deep into specific concession data, they do mention pressure on effective rents. With high vacancy, tenants have the negotiating power. Landlords are having to offer more goodies, free rent periods, bigger allowances for tenant improvements, TIs, just to get deals done. So yeah, the actual cash flow might be weaker than that small 1.1% rent growth figure suggests.
Now, is this hitting all office buildings equally? Or is there a difference between the shiny new towers and the older ones, Class A versus B and C?
Oh, absolutely. That's a critical fault line in the office market today. The performance varies hugely by building quality. Class A, typically the newer, higher quality buildings, better locations, more amenities.
The ones everyone wants to be in, theoretically.
Right. Surprisingly, they actually have the highest national vacancy rate, around 20.5%.
Higher? Why is that?
Well, partly because that's where most of the new construction has been concentrated. Lots of new, high-quality space delivered. And maybe larger tenants in those buildings did more significant downsizing. But, and this is key, Class A is also showing the biggest improvement in demand. Negative absorption in Class A dropped by a whopping 86% year over year.
Okay, wait. So highest vacancy, but demand is recovering fastest there. What does that tell you?
It suggests a flight to quality. Companies that are leasing space or renewing leases, they want the best environments, maybe to lure employees back to the office, maybe just because they can get good deals on top-tier space right now. They're concentrating in those better buildings.
Makes sense. What about Class B and C?
Class B, older but still decent functional buildings, their vacancy rate is more stable, around 12.0%. That's actually below the national average. And Class C, the oldest, lowest quality properties, they technically have the lowest vacancy at 5.2%.
Lowest? That seems odd.
Yeah, it can be a bit misleading. Often, Class C tenants are smaller businesses, maybe with less flexibility to move, or the buildings are in less desirable locations and just aren't competing for the same tenants as Class A. So low vacancy doesn't necessarily mean strong demand. The key takeaway is that demand momentum seems to be strongest at the top end in Class A, even though they have the most space to fill right now.
And I assume location matters hugely, too. Some cities must be doing better or worse than others?
Oh, massively. Real estate is always local, right? The impact of remote work, local economic shifts, it plays out very differently city by city. The sources give examples. Cities like Boston and Washington, D.C. saw really large absolute losses of occupied office space.
Okay.
San Francisco, which was hit incredibly hard earlier on, saw the pace of its space losses slow way down. Went from losing 9 million square feet in Q1 2024 to losing only 3.4 million in early 2025. Still negative, but slowing.
Any bright spots?
Yeah, a couple mentioned. New York City actually showed a pretty notable rebound. It went from negative absorption to positive absorption, taking up over 1 million square feet year over year. Sacramento also saw positive absorption, over 1 million square feet in the last 12 months. So it really highlights that you can't paint the entire U.S. office market with one brush.
Yeah, definitely not. So with all these challenges, what kind of yield are investors demanding for office? What's the average cap rate look like?
The average cap rate mentioned for office is 9.0%.
9%. That's quite high compared to other sectors, right?
It is significantly higher than retail or industrial. And that reflects the higher perceived risk, right? The uncertainty about future demand, the potential need for significant capital investment. Investors simply need a higher potential return to justify putting money into such a challenged sector right now. Remember, higher cap rate generally means lower price for the same amount of income.
So boiling it down, what are the biggest sort of structural challenges that office is still grappling with?
Well, number one is definitely the lasting impact of remote and hybrid work. It's not just about filling empty desks anymore. It fundamentally changes the dynamics of central business districts, the CBDs.
How so?
Fewer people commuting into the office every day means less foot traffic for the surrounding retailers, the restaurants, the coffee shops. It impacts public transit usage. And ultimately, it can hit the city's tax base and just the overall economic vibrancy of downtown areas.
Right, it's a whole ecosystem.
Exactly. And then there's the difficulty in getting financing, especially for older buildings or redevelopment projects. Securing capital is tough. Plus, many older buildings need significant investment to meet what tenants want today. Better air systems, more collaborative spaces, updated tech infrastructure, those kinds of amenities. It costs money.
There's always talk about converting empty office buildings into apartments or something else. Is that a realistic solution at scale?
It's definitely part of the conversation, and the sources touch on it. Converting office space, especially maybe older Class B or C buildings in certain locations, into housing or maybe healthcare facilities or even educational uses, it's being explored. Cities like New York are actively looking at ways to facilitate this.
There's always a but.
But yeah, the reports are clear that it's often really complex and expensive. You've got structural challenges. Office floor plates aren't always ideal for residential layouts. Plumbing, windows, lots of issues. Then there are zoning hurdles and often big financing gaps.
But it's not a magic bullet.
No, not at all. Repurposing efforts are emerging, and they'll be important for revitalizing some areas. But it's unlikely to be a widespread solution that absorbs, the majority of vacant office space across the country. Revitalizing CBDs is going to take a much broader approach, diversifying uses, public-private partnerships, focusing on safety, infrastructure, the whole urban experience.
And the debt situation for office specifically, that sounds particularly worrying from the reports.
It really is. The delinquency rate on office loans is notably high compared to other property types. It hit 7.8% in the third quarter of 2024.
Wow, almost 8%.
Yeah, and that was a big jump from just 5.1% a year earlier. This is critical because office loans make up a really substantial chunk of the commercial mortgage-backed securities, CMBS, market. So when office loans go bad, it can create wider ripples in the financial system and force lenders and borrowers into some very difficult workout situations or distressed sales. It's a key area to watch.
Okay, definitely a tough picture for office. Let's pivot now. Let's talk about retail. This sector had its own near-death experiences with e-commerce. Then the pandemic hammered it. What's the story there now, according to the sources?
Right, retail. Everything from the big shopping malls down to the local strip centers and single-tenant shops. It's certainly been through the ringer. But here's the surprising twist that the sources really highlight.
Okay.
Despite all the doom and gloom narratives about the retail apocalypse, retail actually maintains the lowest national vacancy rate among the major commercial property types right now.
Lowest. Seriously, that is surprising. What's the number?
According to one report, the national retail vacancy rate is only 3.8%. Really tight.
Wow. Why is it so low?
It largely comes down to supply, or rather the lack thereof. For decades, really, partly because of that looming threat of e-commerce, there just hasn't been a lot of new retail space built compared to demand. development was very cautious.
So underbuilding for years?
Pretty much. Now, the vacancy rate did tick up very, like 0.1 percentage points in the most recent quarter, the first small increase in over 2 years. But fundamentally, many areas are still undersupplied. And one source, Crow Holdings, actually makes the case that this long period of, poor relative performance and undersupply retail share in that entry IOF index shrank dramatically. From 23% down to just 13% might actually set it up for outperformance in this cycle, especially for well-located essential retail.
Interesting. So low vacancy. What about demand absorption? Is that strong?
Well, that's where it gets a bit mixed. Net absorption for retail actually fell quite significantly, down 77% year over year compared to the previous period. So demand has definitely softened from its peak.
Okay, so demand is softer, but vacancy is super low. What does that do to rents?
Rents are still growing. Nationally, about 1.9% annual growth. It sounds counterintuitive, right? Softer demand, but rising rents.
Yeah.
But it goes back to that tight supply. Even with less net leasing activity, the lack of available space, especially in prime spots, means landlords still have some pricing power. There's competition for the good locations.
Are all types of retail doing the same? Malls versus strip centers?
No, definitely variation there too. The data shows that general retail thinks standalone stores, maybe some smaller centers and traditional strip centers, are really driving almost all the positive absorption, like 98% of it.
Okay.
Neighborhood centers, the ones usually anchored by a grocery store, they actually saw some negative absorption recently. And malls. Well, malls surprisingly held their vacancy rate steady at 8.7%.
Steady.
The sources note that's partly because some older vacant mall space is being demolished or repurposed, so it gets taken out of the vacancy calculation. It's not necessarily that all that space got leased up.
Ah, okay. Statistical quirk.
A bit, yeah. In terms of fundamentals, general retail has the absolute lowest vacancy, just 2.6%. Meanwhile, neighborhood centers and power centers, those are the big strip centers with multiple big box stores, they're actually seeing the strongest rent growth, both around 2.7% or 2.8%. Probably reflects demand for essential goods and services.
And what's the typical cap rate for retail? Where does it sit relative to office?
The average cap rate given for retail is 7.1%.
Okay, so lower than office's 9%, which makes sense given the lower vacancy and maybe more stable income.
Exactly. It reflects that perceived stability, but it's generally a bit higher than industrial, which we'll get to in a moment.
And geographically, I assume retail performance varies a lot too.
Oh yeah, big time. Depends heavily on local factors. Population growth, consumer spending strength, how much supply exists locally. The sources highlight some examples. Cities like Salt Lake City, Norfolk, Greenville saw really strong rent growth, over 6% year over year.
Nice.
But then you had markets like Akron, Ohio, and Hartford, Connecticut, where rents actually declined by more than 3%. On the absorption side, Dallas-Fort Worth was the national leader, soaking up the most retail space. Los Angeles, interestingly, saw net space losses. So huge variation.
Well, we have to remember the context here, right? The whole e-commerce disruption.
Absolutely. The sources emphasize that. Since around 2014, e-commerce really started biting into physical retail.
Yeah.
That made developers cautious, slowed down absorption trends, and then the pandemic accelerated a lot of that. So the current situation, low vacancy, some rent growth, even with softer absorption, is really the result of that decade-long hangover of limited supply finally meeting, continue, maybe reshaped, but still present. Consumer demand for physical stores, experiences, and local convenience.
Okay, fascinating perspective on retail. Now let's move on to the third pillar, industrial. Warehouses, logistics, manufacturing. This sector was on an absolute tear for years. What's the current state of play?
Yeah, industrial was definitely the golden child of CRE for a good while there, explosive growth. But it's clearly in a transition phase now. After that period of historically low vacancy and just off-the-charts rent growth, the market dynamics are shifting. It's becoming more favorable for tenants.
Why the shift? Too much building.
Bingo. A massive wave of new supply, mostly warehouses and logistics centers, has been delivered over the last year or two and has simply outpaced the recent level of demand, even though demand is still positive.
How is that showing up in the numbers? Vacancy must be climbing.
It is. The national industrial vacancy rate has been rising steadily for 11 straight quarters now. It's reached 7.0% according to one source, maybe around 6.9% in Q1 2025 according to another.
7%. How does that compare to the boom times?
It's the highest level in over a decade. During the peak, vacancy rates were down below 4%. So it's a pretty significant jump.
And that rise is directly because absorption demand has slowed down.
Directly linked, yes. Net absorption fell pretty dramatically, down 42% year over year, landing around 114 million square feet nationally in the latest figures. Now, demand hasn't vanished, let's be clear, but the sheer volume of new space delivered. One source put it at around 322 million square feet in the last 12 months.
Whoa.
Yeah. It just dwarfed the absorption. Supply outpaced demand by roughly a 3-to-1 ratio. That's why vacancy shot up.
Okay, 3-to-1, that's a big imbalance. And that has to be putting the brakes on rent growth, right?
Oh, absolutely. Rent growth has decelerated significantly. We are seeing double-digit annual rent growth during the peak. Now, It's softened to around 2.0%, maybe 2.1% year over year nationally.
It's still positive, but way down.
Way down. And importantly, the sources note there's increasing pressure on effective rents, too. Landlords are having to offer more concessions again, longer free rent periods, especially for the bigger warehouse spaces, to lure tenants in this more competitive landscape.
Makes sense. What's the average cap rate for industrial looking like?
The average cap rate mentioned is 7.3%.
Okay, so pretty similar to retail's 7.1% on average, interestingly.
Yeah, nationally they're close, though obviously the drivers and risks are different. And despite this current slowdown, this rise in vacancy, the sources are pretty consistent in saying industrial remains one of the most fundamentally sound asset classes in CRE long term.
Why is that? Still strong tailwinds.
Yeah, things like the continued growth of e-commerce, even if it's normalizing. Shifts in inventory management companies wanting to hold more inventory closer to consumers after all the supply chain chaos, and potential manufacturing reshoring. Those are powerful long-term drivers supporting demand for industrial space.
Is this slowdown hitting all types of industrial properties the same way? Big warehouses versus smaller ones?
Not at all. There's a very clear difference based on size and type. The big box warehouses and logistics facilities, say over 100,000 square feet, those have been most impacted by this flood of speculative construction.
That's where most of the new building was focused.
Exactly. Vacancy for logistics properties overall is around 7.8%. But it's really that big box segment that saw the biggest jump in empty space.
What about smaller industrial spaces?
Much tighter. Smaller base spaces, maybe under 50,000 square feet, they remain in much better shape. Vacancy rates there are still pretty low, around 3.8%.
Why the difference?
Well, they serve a really diverse tenant base, lots of smaller local businesses, and it's often harder to build new small bay product, especially in established infill locations. There just isn't as much land, and construction costs can be prohibitive. So less new supply pressure.
And rents? Flat for big box, better for small bay.
Generally, yeah. Rent growth for most of the large logistics space is pretty flat now, maybe even slightly negative on an effective basis in some markets. Small bay is still seeing modest rent growth. Interestingly, though, the sources mention that the absolute newest mega-sized facilities, like over 500,000 square feet, which were often pre-leased before construction even finished, they're still commanding pretty strong effective rents because of their scale, modern features, and strategic locations.
What about other types, like flex space or manufacturing?
Flex space, that kind of hybrid warehouse-office combo, it's doing relatively better than the big box logistics warehouses. There's much less new flex supply being built, maybe only 20 million square feet under construction nationally, compared to over 200 million square feet of pure logistics.
Wow, big difference.
Yeah. So rents for flex are still growing modestly, maybe 2-3% year over year, averaging around $18.75 per square foot. Demand comes from all sorts of users who like that mix. And the sources also mention potential for adaptive reuse, converting older properties, maybe even tired office parks, into flex space.
And pure manufacturing facilities.
Those have been really resilient. Vacancy rates are quite low, around 3.9%, and the construction pipeline there is pretty limited and mostly driven by build-to-suit projects specifically built for a known tenant.
Often linked to those government initiatives.
Exactly. Fueled by things like the Cheap GPS Act for semiconductor plants or the Inflation Reduction Act supporting clean energy manufacturing. So rent growth there is steady, maybe modest, but reflects the strategic long-term importance of these facilities.
Geographically, where are the biggest risks of oversupply in industrial, and where is it holding up better?
Yeah, location is critical here too. Some markets, especially certain areas in the Sun Belt and the Midwest, just saw a ton of speculative building. Those areas face higher oversupply risk now, more pressure on rents and vacancy.
Okay.
Coastal markets and infill locations within major cities tend to have higher barriers to new development, less land, tougher permitting. So they're generally performing better, less exposed to the supply wave. And as we said, there are still shortages of good small bay space in many fast-growing cities.
Any specific city examples from the reports?
Sure. For recent absorption activity, Dallas-Fort Worth and Savannah, Georgia were highlighted as leaders. Markets like Los Angeles and Memphis saw the weakest absorption numbers. And rent trends varied too. Some secondary markets like Cincinnati and Dayton actually saw continued rent increases, while previously super hot markets like LA and Austin experienced declines in effective rents as concessions rose.
So with all this new supply working its way through the system, what's the outlook? When does the industrial market maybe find its footing again?
The general outlook from the sources is actually fairly optimistic about stabilization happening reasonably soon. The consensus seems to be that national industrial vacancy rates will probably peak sometime in late 2025 or maybe early 2026.
What makes them think that?
It's mainly because new construction starts have absolutely plummeted. They're apparently at 10-year lows right now. The pipeline of projects already under construction is shrinking rapidly, so the flood of new deliveries is going to slow to a trickle over the next 12 to 18 months.
Okay, supply growth slows way down.
Right. And even if demand absorption just continues at a moderate pace, that slowing supply should allow the market to gradually absorb the excess space. The gap between supply and demand should narrow.
And then maybe rents start growing again.
That's the expectation. This resetting of the supply-demand balance is anticipated to set the stage for renewed rent growth, probably more modest than the crazy boom years, but positive growth nonetheless, potentially starting sometime in 2026, especially in those markets where the future development pipeline looks really thin.
Okay, that gives us a really detailed picture of the three main sectors. Let's maybe pull back again now and talk about some of the big overarching issues and trends that are affecting all of commercial real estate based on what the sources are saying.
Sounds good. And a central theme, really the one we kicked off with, is the cost of financing. It's just casting a long shadow over everything.
The end of cheap money.
Exactly. That era of near zero interest rates is definitively over. Higher borrowing costs have fundamentally changed the math for buying, developing, and refinancing properties. It's not just making new deals harder to pencil out. It's creating huge challenges for existing owners who need to refinance. Plus, it injects this layer of uncertainty that's keeping a lot of potential buyers sitting on the sidelines, waiting to see where things settle.
And the sources think this higher rate impact will stick around for a while.
Yeah, the general feeling seems to be that the full effects on deal volume, on price discovery, are likely to persist for at least another year or two. It takes time for the market to fully adjust to a new cost of capital reality.
And that leads right back to that massive wall of loan maturities we started with, that $1.8 trillion coming due before 2026. Can we dig into the implications of that a bit more?
Yeah, this is arguably the single biggest, most immediate challenge facing the market. A huge volume of loans, many originated when rates were at rock bottom, are now coming due in this completely different rate environment.
So refinancing is going to be painful.
Potentially very painful. The cost of new debt is so much higher now. For some owners, their debt service payments could literally double or even more. That makes it incredibly difficult, maybe impossible, for some properties to generate enough cash flow to cover the new, higher mortgage payments, especially if rents haven't kept pace or vacancy has risen.
So what happens then? Defaults, fire sales.
That's the big question the market is grappling with. How does this massive volume of debt get absorbed or restructured? There's certainly potential for distressed situations, forced sales, especially for properties in tougher sectors like parts of the office market or maybe older retail.
But maybe also an opportunity.
Definitely. The sources frame it that way too. For investors who've been patiently waiting on the sidelines with dry powder, this situation could create significant opportunities to acquire assets at discounted prices.
Are lenders just kicking the can down the road, extending loans?
There's been a fair amount of that, yes. Extend and pretend, as they sometimes call it. Lenders have been willing to grant short-term extensions where possible, hoping conditions improve. But there are limits to how long that can go on, especially if the underlying property performance continues to weaken or if regulators push back. The market is watching very closely to see how lenders and borrowers navigate this, and crucially, how much capital is actually available and willing to step in to bridge these financing gaps.
And overall CRE debt levels themselves have gone up too, right? It's not just about maturities.
Correct. Total commercial real estate debt outstanding hit $3.01 trillion as of February 2025. It's a huge number. And alongside that growth, delinquency rates are ticking up, although outside of office, they're still relatively low compared to, say, the GFC. The overall CRE loan delinquency rate was 1.57% in Q4 2024.
So up, but not catastrophic overall.
Not catastrophic overall, but definitely showing signs of increasing pressure. One interesting point from the sources is that historically, commercial loan delinquencies often tracked lower than residential mortgage delinquencies. But that gap has been narrowing recently. It suggests CRE might be feeling relatively more stress in this particular cycle compared to past ones.
And just to reiterate, office is the big outlier there with that near 8% delinquency rate.
Yes, that 7.8% figure for office is way above the average and is definitely the main driver of concern within broader benchmarks like CMBS.
Okay, moving beyond finance, what about bigger picture stuff? Geopolitics, global events, how are those filtering down to U.S. CRE?
Well, global conflicts, like the situations in Ukraine or the Middle East, they create these complex ripple effects. They can disrupt supply chains, which impacts construction costs and tenant businesses. They can add to inflationary pressures. They contribute to broader economic uncertainty, which might make tenants hesitant to sign long leases. And they can even exacerbate global issues like housing affordability.
Seems mostly negative then.
It's actually a bit contradictory. On one hand, yes, those negative impacts are real. But on the other hand, during times of global turmoil, U.S. assets, including commercial real estate, are often seen as a relative safe haven for international capital.
Ah, so it can attract investment too.
It can, which can provide a sort of floor under demand and pricing, at least for certain types of assets. But the sources specifically note that the persistence of this geopolitical risk is one factor contributing to the expectation of a higher-for-longer interest rate environment. Investors just demand a higher risk premium when the world feels uncertain.
And higher risk premium means?
Generally means upward pressure on cap rates and potentially downward pressure on property values. It disrupts the traditional CRE investment cycles we might have expected otherwise.
What about domestic politics? The sources mention the 2024 U.S. elections as something people are watching. How might policy changes impact CRE?
Yeah, elections always bring a degree of uncertainty. The sources highlight a few key areas where policy shifts could matter for CRE. Tax policy is a big one. Changes to capital gains rates, depreciation rules, or investment incentives could definitely influence deals.
Infrastructure spending.
That too. Big infrastructure projects can significantly impact property values and development opportunities in specific corridors or regions. And then there are regulations, things related to zoning, environmental standards, labor laws. Those can all affect construction costs, timelines, and operational requirements.
Anything specific mentioned about recent policy?
There's a brief mention of an initial analysis of some recent executive orders suggesting they might have disinflationary effects, which could theoretically be good for real estate liquidity by helping bring rates down. But it was framed very cautiously, emphasizing that a full assessment is still needed. It's really just a reminder that policy matters, from the federal level right down to local zoning boards.
Okay. Another issue hitting owners' wallets seems to be insurance costs. The sources mention those are soaring.
Yeah, that's a huge pain point right now.
Yeah.
Property insurance premiums are going through the roof in many areas.
Why? What's driving it?
It's a nasty cocktail of factors. General inflation pushes up the cost to rebuild if something happens. Then you have the increasing frequency and severity of extreme weather events, hurricanes, floods, wildfires, severe storms. One report mentioned $380 billion in global natural disaster damages just last year.
Wow.
And insurers facing massive losses from these events are having to drastically increase premiums to cover their own costs and rebuild their reserves. So property owners, especially in disaster-prone regions like Florida or California, are getting hit with massive increases, sometimes double or even triple-digit percentage hikes year after year.
That's got to crush cash flow.
It absolutely does. It's a direct hit to net operating income, NOI, which directly impacts property values. Owners are scrambling to manage it. They're working with brokers, looking at higher deductibles, maybe exploring things like aggregate deductibles across a portfolio where they self-insure the initial layer of losses. Some are even looking at alternative risk transfer mechanisms or captive insurance programs. But it's a major, major headwind right now.
You mentioned housing affordability earlier. How does that crisis connect back to commercial real estate? Seems like a separate issue.
It's deeply interconnected, actually, especially with the multifamily sector, which is a huge part of CRE. The housing affordability crisis in the U.S. is, well, it's dire. Multifamily rents are up something like 45% nationally since 2009, according to one source. There's an estimated shortage of over 4 million housing units.
4 million units?
Yeah. And as a result, nearly 54% of renters are now considered cost burden, meaning they spend over 30% of their income just on rent. It's unsustainable for many households.
And multifamily construction hasn't fixed it.
Well, multifamily construction has been pretty robust recently, but the sources point out a key issue. It's been heavily concentrated in just a handful of metro areas, so you get oversupply in those specific markets, driving rents down locally perhaps, while many other parts of the country remain desperately underserved.
So how can CRE help beyond just building more apartments?
Well, continued multifamily development is obviously part of the solution. There's also the potential role of converting underutilized commercial buildings, maybe those struggling office buildings we talked about, or certain types of retail into residential units.
The conversion idea again?
Right. It can help chip away at the shortage, but, as we discussed, it's complex and costly. To really make a dent, it requires not just private investment, but significant government support, things like financial incentives, subsidies, and, crucially, zoning reform at the local level to actually allow for denser housing and streamline the approval process. It's a tough nut to crack, needs everyone working together.
What about tech? Artificial intelligence, AI is everywhere. Is it making waves in real estate yet?
It's definitely emerging, yeah. People are using AI for things like optimizing rent pricing for apartments based on real-time demand signals, or maybe improving building energy efficiency management. Lots of potential applications.
But are there challenges?
Big challenges. The sources highlight that AI runs on data, lots of accurate, granular, timely data. And the real estate industry, while it generates tons of data, often has it locked up in fragmented, inconsistent systems. Different property managers use different software. Data formats vary. Getting clean, standardized data to train AI models effectively is a real hurdle. There's often a lack of context for the algorithms.
So AI's impact in managing buildings is maybe still developing.
Still evolving, yes. But here's where AI is having a massive direct impact on CRE right now. Data centers.
The buildings needed to run the AI.
Exactly. The sheer computing power needed for AI development and deployment is fueling enormous demand for specialized data center facilities. And those data centers fall squarely under the industrial property sector umbrella. So AI's infrastructure needs are creating a huge new demand driver for certain types of CRE.
Interesting angle. Another big global trend is sustainability, ESG. How's that playing out in commercial buildings?
Sustainability is moving rapidly from being a kind of nice to have to a core business and investment imperative in CRE.
It's pushing it.
There's several things. Those extreme weather events and rising insurance costs we talked about make building resiliency a financial necessity. Then there's the evolving regulatory landscape. Europe has been ahead on this, but now we're seeing more U.S. states putting mandates in place around building energy performance, emissions reporting, things like that.
So owners have to pay attention now.
They really do. They increasingly need to understand their building's carbon footprint, figure out pathways to decarbonize. But the sources frame this not just as a cost or a compliance burden. Investing in energy efficiency, using sustainable materials, making buildings more resilient to climate impacts. It's seen as future-proofing the asset.
How so?
Well, it protects the building's value from becoming obsolete as regulations tighten and tenant expectations rise. It can lower operating costs, especially energy bills, and it meets the growing demand from both tenants and investors who are prioritizing environmental, social, and governance ESG factors in their decisions. Greener, more efficient buildings are simply becoming more valuable.
Okay, one last big trend, that valuation lag and the gap between buyers and sellers. Where does that stand now? Is the gap closing?
The sources suggest that the gap, while it's definitely still there, might not be widening anymore. Prices, especially for troubled assets like CBD offices, fell pretty sharply through 2023. That CBD office price index, for example, was down almost 30% year over year in Q2 2024, though the pace of decline was slowing.
But industrial prices were still going up then.
Yeah, interestingly, industrial saw prices increased by 8.6% in Q2 2024, reflecting its relative strength during that specific period. So it's very sector dependent.
So the initial shock of rates rising might be mostly priced in, but buyers and sellers still aren't quite meeting.
Seems to be the case. But that looming wave of loan maturities we keep coming back to, that's expected to be a major catalyst here.
How? Forcing sellers' hands.
Potentially, yes. As owners face those difficult refinancing hurdles, some might simply be forced to sell, even if it's at a price lower than they'd ideally want. That could bring pricing down to levels where buyers, especially those opportunistic funds sitting on cash, are willing to step in. That forced selling could be what finally bridges the bid-ask gap.
Or maybe lower interest rates could help.
That too. If interest rates do decline later this year or next, that would improve affordability for buyers. Or if rent growth picks up again in certain sectors, that boosts property income and could also help justify higher prices, narrowing the gap from the other side. So a few potential paths to closing that gap, but the loan maturities seem like the most immediate pressure point.
Okay, we've covered market trends, sectors, finance. Let's shift gears slightly and talk about the day-to-day operational side. Property management, keeping tenants happy. In a market like this, how crucial is tenant retention?
Oh, it's absolutely paramount, especially in sectors like office with high vacancy or even in retail where competition is fierce. Keeping the tenants you already have is way, way cheaper and less disruptive than finding new ones.
Why is it cheaper?
Think about it. When a tenant leaves, you might have downtime where the space sits empty, generating no income. You often have to pay brokerage commissions to find a new tenant. You might need to spend significant money on tenant improvements, TIs, to customize the space for the new occupant. Retaining a good tenant avoids all that churn and expense. Plus, stable occupancy looks much better to potential investors or lenders if you ever want to sell or refinance the property.
Makes sense. And the sources mentioned that what tenants want is changing too.
Yeah, definitely. Especially with shifts in work habits and just general expectations. It's not just about four walls and a roof anymore. The sources list several things modern tenants really value.
Like what?
Flexible lease terms are huge, especially for office tenants who might be unsure about their future space needs. Robust security is always high on the list. Good property upkeep. Nobody wants to work or shop in a rundown place. Access to modern technology within the building is increasingly expected. And alignment with sustainability tenants, especially larger corporations, often have their own ESG goals and want their landlords to be on the same page.
So property managers need to up their game.
They really do. It's about moving beyond just collecting rent and fixing leaky faucets. The sources emphasize it starts with really knowing your numbers, tracking key performance indicators, KPIs, beyond just the headline occupancy rate.
What kind of KPIs?
Things like your actual vacancy rate, the average number of days it takes to lease up a vacant unit, and maybe most importantly, your tenant turnover rate. Are tenants leaving frequently? Why? Monitoring those metrics tells you if your retention strategies are actually working.
Okay, data first, but then it's about the actual experience, right? The property, the service.
Absolutely. Offering desirable amenities is key, and it needs to be tailored. For an office building, maybe it's a good coffee shop downstairs, a fitness center, maybe some shared meeting or collaboration spaces. For a retail center, maybe improved common areas, better signage, ample parking.
Even simple stuff matters.
Totally. Just keeping the property well-maintained, clean, maybe some nice landscaping. It makes a difference in how tenants feel about being there. And then there's the service aspect. Offering flexible pricing or incentives, especially if a tenant is willing to sign a longer lease, can be effective. Think discounts, maybe offering an upgrade, sometimes even packaging utilities.
And the human touch, relationships.
Fundamental. Building strong relationships and prioritizing really good customer service is critical. How easy is it for a tenant to report a maintenance issue? How fast and effectively does the property manager respond? Do managers proactively communicate? Do they solicit feedback, maybe through surveys? Do they host tenant appreciation events? Just making tenants feel valued, heard, and respected goes a long way.
The sources also mentioned something about community involvement, conscious capitalism.
Yeah, that was an interesting point. The idea that property owners and managers who are active and positive contributors to the surrounding community can actually foster tenant loyalty. This might mean partnering with local charities, participating in community events, operating ethically, looking beyond just maximizing profits. Tenants, especially younger generations and mission-driven companies, increasingly want to be associated with landlords who share their values.
Okay, and one specific area highlighted for retention was security, particularly using technology.
Yes, security is a huge factor in tenant satisfaction and retention across all property types. And the sources specifically pointed to the effectiveness of advanced video surveillance systems that include live monitoring.
So not just cameras recording, but someone watching?
Exactly. Traditional cameras are mostly useful after a crime has happened for evidence. Proactive security is about preventing incidents in the first place. These modern systems use AI analytics to detect suspicious activity, someone lurking around after hours, for example, and then alert a live, trained human operator.
And the operator can intervene.
Yes. They can often issue live audio warnings through speakers on the property like, "You're being monitored, please leave the area." That alone deters a lot of crime. If the person doesn't leave, the operator can immediately contact police or security dispatch with verified, real-time video evidence.
Which gets a faster response, presumably.
Usually, yes. Police tend to prioritize verified crimes in progress over a simple alarm bell. The sources noted that this kind of proactive security can provide a tangible ROI pretty quickly, just by reducing losses from theft or vandalism, or potentially lowering guard costs. But maybe even more importantly, it gives tenants significant peace of mind knowing the property is being actively watched over. That feeling of safety is huge for retention.
Makes sense. Okay, one last major area to cover: the future pipeline. What's being built? What does the development and construction outlook tell us about where the market might be headed?
Well, the development pipeline definitely reflects the more cautious mood in the market right now. Compared to the frenzy of building a few years ago, things have slowed down considerably. The sources indicate that the number of national construction completions actually peaked back in late 2023 and is now declining pretty sharply. The forecast is for completions to fall below 40 million square feet per quarter by early 2026. And the total amount of space currently under construction nationally, around 300 million square feet, is also down from where it was a year ago.
And developers aren't starting many new projects without tenants lined up, right? Less speculative building?
Very little speculative building, exactly. The vast majority of new construction starts now are either build-to-suit projects custom built for a specific tenant who's already signed a lease, or projects that have managed to secure substantial pre-leasing commitments before even breaking ground. Trying to get financing for a purely speculative project right now without strong pre-leasing or a lot of equity is extremely difficult. Lenders are very risk-averse.
How long does it typically take to build these different types of properties?
The source averages give a rough idea. Industrial and retail projects are generally the quickest, maybe 16 to 18 months from groundbreaking to completion. Multifamily apartments take longer, usually 22 to 24 months. And office buildings, with their complex interior systems and finishes, tend to take the longest, often closer to 3 years.
But that varies a lot by location, I imagine.
Oh, for sure. Local permitting processes, labor availability, site conditions, all that can significantly impact timelines from city to city.
So how do analysts figure out when a specific market might reach, like a balance between all this new supply and the actual demand?
It's a bit of an art and a science. They look at the current occupancy rate compared to its long-term historical average for that market. Then they analyze the amount of space that's currently under construction and compare that to forecasts of future demand or absorption for that market. That helps them estimate when the new supply might get soaked up and the market returns to a more balanced state or equilibrium.
And the sources actually categorize markets based on this outlook.
Yes, they provide a useful framework. They put markets into roughly 3 buckets based on when they might reach equilibrium and what the future development potential looks like.
What are the buckets?
First, you have markets that are considered undersupplied right now, with relatively little construction underway. The thinking is, new projects starting soon in these markets could potentially deliver into a rising market environment by 2026, when conditions might be better. Chicago and Minneapolis were given as examples here.
Okay, undersupplied. What's next?
Second, there are markets expected to reach equilibrium sooner, maybe late 2025 or early 2026. These are places where the current construction pipeline isn't seen as totally overwhelming relative to projected demand. Boston and Houston were mentioned in this category.
Got it. And the third?
The third group includes markets that have a significant amount of construction already in the pipeline. These places might take longer to absorb all that new space and reach a balanced equilibrium, possibly not until later in 2026 or even 2027. Atlanta and Austin were cited as examples of markets with substantial ongoing construction that needs to be absorbed.
That's a helpful way to think about different city outlooks. Are there any innovations happening in construction itself that the sources mentioned?
Yeah, a few trends. Things like modular or prefabricated construction methods are gaining more attention, trying to improve efficiency and maybe reduce timelines and costs. In dense urban areas where land is scarce, especially for industrial, you're seeing the emergence of multi-story warehouses building up instead of out.
Vertical logistics.
Exactly. And across all sectors, there's just a much greater focus now on integrating sustainable building features right from the design phase. Making buildings solar-ready, using energy-efficient LED lighting throughout, incorporating EV charging stations, designing to meet green building standards like LEED. These are increasingly becoming baseline expectations, not just optional extras.
Wow. Okay. We have covered a ton of ground today, haven't we? I mean, from the surprisingly resilient economy and how CRE fits in as an investment, then diving deep into office, retail, industrial. The good, the bad, the ugly.
Yeah, and then all those cross-cutting themes, the financing crunch, the debt wall, geopolitics, insurance costs, AI, sustainability, right down to keeping tenants happy and what's coming down the construction pipe.
It's definitely a complex picture, multi-layered, as you said earlier. It's so clear that commercial real estate isn't just one thing. It's this incredibly diverse landscape, constantly changing, with huge differences between sectors, between cities, all reacting to these big economic forces and capital market shifts, but also driven by what's happening right there on the ground in that specific building.
Absolutely. It's not a monolith at all. Performance is incredibly divergent right now. And understanding that interplay between the macro and the micro is key.
Totally. And as you, the listener, think about everything we've unpacked today, the impact of remote work, the rise of e-commerce, the pressure from higher borrowing costs, those looming loan maturities, the push for greener buildings, the role of AI. It strikes me that these aren't just abstract trends affecting balance sheets. They're actually reshaping the physical places around us all.
That's a great point. They have tangible consequences for our built environment.
So, maybe a final thought or question to leave you with as you go about your day. Look around your own community. Look at the office buildings downtown, the shopping centers you go to, maybe those industrial parks on the edge of town. How might the powerful forces and the specific sector dynamics we've discussed today actually change the purpose, the look, the feel of those places in the years ahead? And what does that ultimately mean for how you interact with them, how you experience your own community?
It's a fascinating connection to make how these big financial and economic shifts translate into the physical reality of where we live, work, and shop.
Definitely something to ponder. Hopefully this deep dive gave you a solid foundation for understanding the current state of U.S. commercial real estate. But as we've seen, it's a constantly evolving story. Staying informed, keeping an eye on the data, and seeing how these trends play out in the places that matter to you, that's really key to navigating this dynamic landscape going forward.